So here's a simple question with a no simple answer. How do multinational companies decide how much one branch charges another for goods, services, or even intellectual property? If a Polish subsidiary makes up car parts and sells them to its German parent company, how do they set the price? How does it affect profits and taxes across different countries? So that, my friends, is the world of transfer pricing. Today we are breaking it down. What it is, why it matters, and how global businesses use it or misuse it every single day. So if you are a CFO, finance manager, consultant, entrepreneur, or just trying to wrap up your head around international tax strategy, this video will give you a rock-solid foundation. Oh, and a quick intro, if we haven't met before. My name is Michael. I'm a lawyer and economist by training, a business consultant and analyst by profession, and a business owner like many of you. I run a company called PREZO. You can check us out at the link provided in the description below. We specialize in transfer pricing, business analysis, and helping small and medium-sized to scale by using tested and legal frameworks. We are working with over 100 companies yearly. Tech startups, manufacturers, e-commerce sellers, and really, I get it. You want clarity. You want real answers and recommendations. And most importantly, you want your business to grow without giving half your profit away in taxes. So that's what this channel is about, and that's what PREZO is about. So if you are a growing company trying to scale across borders, structure smarter, or just not get crushed by paperwork, this is the place for you. Let's keep it going. Let's start with the basics. What is transfer pricing and why is it one of the most important and most scrutinized concepts in global business today? At its core, transfer pricing refers to the prices charged between related entities within the same multinational enterprise, or MNF for short. Now, when we say related entities, we are talking about companies that are part of the same corporate group. Think like subsidiaries, branches, or even sister companies that are all owned or controlled directly or indirectly by the same parent company. And when we say prices, we are not just talking about physical goods. Transfer pricing applies to a wide range of internal transactions, including sales of goods, raw materials, finished products, components, provision of services like IT support, HR, marketing, legal, finance, use of intangible assets, think like trademarks or patents, like royalties, licensing fees, cost-sharing arrangements, intercompany loans, guarantees, or interest payments. In other words, anytime money or value flows from one group company to another, transfer pricing rules are in play. Now, here's the part that makes things interesting. These group companies are often located in different countries, each with different tax rates, regulations, and incentives. That means the way you set these internal prices can directly influence where the profits are reported, where taxes are paid, and ultimately how much tax the group pays globally. And that opens the door for something very real and very strategic, like tax planning. Let's break it down with a basic example. Imagine a multinational group, let's call it Company A Group. Company A has a manufacturing subsidiary in Mexico. That subsidiary produces electronic parts and sells them to its parent company in the, let's say, United States. Let's say the Mexican subsidiary charges the US parent for $10 per unit. Sounds reasonable, right? But here's the question. Is that price fair? Is it market-based? And what an unrelated company would pay? Or is it the group using that price to shift profit from the US to Mexico? Let's dig into it. So, if the real market price for that product is $20 and the US company is buying it at $10, then most of the profit sits in Mexico. And that matters because, surprise, Mexico might have a lower corporate tax rate than US. So So by setting a low intercompany price, the group can reduce its taxable profit in the high-tax US and increase profits in a lower tax country, right? So from a tax authority's point of view, this is a red flag. It looks like profit shifting. So how do we make sure these intercompany prices are fair? Enter the arm's length principle. This is the golden rule of transfer pricing. It says that the price charged between related parties, say between a Mexican subsidiary and the US parent, should be the same as the price that would be charged between two unrelated, independent parties acting in their own best interest. So in short, treat your related companies like strangers. If a third-party distributor in the US would normally pay $20 for the same product from an unrelated supplier, then your intercompany price should be somewhere close to 20, not to 10. So that's the essence of the arm's length principle. And it's not just a nice idea. It's the international standard, endorsed by the OECD and regulated in the transfer pricing rules of nearly every major country on Earth. Now, you might be wondering, why is this such a big deal, right? Because for multinational companies, transfer pricing determines how profit is allocated across jurisdictions. And when you are operating in 10, 20, or even 100 different countries, a small change in pricing can lead to millions of dollars shifting from one tax jurisdiction to another. For example, if your group shifts just $10 million of profit from a country with a 30% tax rate to one with a 10% tax rate, you are saving $2 million in tax. Multiply that by dozens of transactions, and you get why transfer pricing is so powerful and why it gets so much attention from CFOs, tax directors, and yes, also tax authorities. So, let's flip the lens now. From a government's perspective, transfer pricing is a major revenue risk. Countries don't want to lose tax revenue because a company chooses to book profits in a friendly jurisdiction. So, tax authorities are watching transfer pricing like hawks. They conduct audits, they demand documentation, and in many cases, they challenge the pricing, arguing it doesn't reflect the arm's length standard. So if a tax authority thinks a company undercharged or overcharged in an intercompany deal, they can adjust the price, recalculate taxable profit, and issue a hefty tax assessment, often with interest and penalties. So in fact, transfer pricing disputes are one of the most common and costly types of tax litigation today. Just search for any big multinational's annual report, and you'll likely find a note about ongoing transfer pricing audits in multiple countries. Now, all this raises a practical question. How does a company actually determine an arm's length price? Well, that's where things get technical but also fascinating. Companies typically use one of more of the 5 OECD recognized transfer pricing methods. Comparable uncontrolled price, comparing the price that is charged in a similar third-party deal. Resale price method, looking at resale margins in the distribution chain. Cost plus method, adding a markup to a cost of production. International net margin method, analyzing net profit margins relative to comparables, like profit split method, dividing profits based on each party's contribution. And each method has its strengths and it's suitable for different transaction types. Well, we will explore those in detail in a later video, but for now, take the key takeaway is to setting a fair price takes data, documentation, and judgment. Another key part of transfer pricing is documentation. Most countries require companies to prepare a master file, its overview of the global group and transfer pricing policy, a local file, its detailed analysis of each country, and a country-by-country report showing revenue, profit, and taxes paid by jurisdiction. So these documents aren't just paperwork. They are your first line of defense in an audit. If your documentation is weak, or missing entirely, you are much more vulnerable to tax adjustments. So even small and mid-sized groups need to take documentation seriously, because in the eyes of tax authorities, if it's not documented, it didn't happen. Let's bring this full circle. For a multinational company, transfer pricing isn't just about tax. It affects where the profits show up, how business units are evaluated, how internal incentives are aligned, and even where to invest, expand, or relocate operations. Done right, transfer pricing supports global growth, compliance, and smart decision-making. Done poorly, it creates audit risks, like financial uncertainty, and reputational damage. In other words, this stuff matters. So to recap, transfer pricing is about how related entities in different countries price their international transactions. It covers goods, services, IP, financing, and more. The arm's length principle says these prices should match what independent parties would agree on. So getting it right requires analysis, method selection, and documentation. And it directly affects both your global tax liability and your audit exposure. It's a technical topic, but a strategic one. So, and if your company operates across borders, you can afford to ignore it. You can't afford. In our next chapter, we will go deeper into the methods used to apply the arm's length principle. So, and why choosing the right one is both an art, somehow, and a science. Let's be honest. Transfer pricing doesn't exactly scream excitement at the first glance. But when you dig into it, you realize this one concept quietly shapes where billions in global tax revenues end up. So it influences how companies structure operations, make investment decisions, and manage financial performance. Let's explore it, why it matters so much. Not just for tax people, but for the entire business. Here's the thing. Multinational companies don't just operate in one country. They are producing in one place, selling in another, doing R&D somewhere else, and holding IP in yet another jurisdiction. So how they decide which country gets how much of the profit? Transfer pricing decides that. It's the mechanism that tells the world this chunk of profit belongs in Germany, that part in Singapore. Oh, and this other slice, Mexico. So change the internal pricing even slightly and you shift profit across borders. And in a world where corporate tax rates from 9% to over 30%, that shift has a real financial consequences. Let's say your group has two subsidiaries. One in a high-tax country, say France, with a 32% effective tax rate, and another in a low-tax country, let's say in Hungary, where there is a 9% tax rate. In the French company, let's say it pays a high price to the Hungarian one. The French entity shows lower profit and lower taxes, while the Hungarian one books more profit but a much lower tax rate. So congratulations, you just saved your group a ton of money. Now, is this legal? Yes. If done properly, at arm's length with documentation, it's legal. But if the prices are manipulated, or if there is no real business substance behind it, you are walking straight into the audit. This is where transfer pricing goes beyond tax. It influences how businesses structure themselves. Where should where should your group hold IP? Where should your financing arm be located? Should you set up a principal company to coordinate all global sales? Should your marketing entity be a profit center or maybe a cost center? These questions they all come back to one simple question. How will this impact our transfer pricing and overall tax profile? Many companies choose to centralize high-value functions like R&D or brand ownership in the jurisdictions that offer tax incentives. This isn't shady. It's smart planning, but it needs to be carefully aligned with operational reality, because if the tax structure gets too far ahead of the actual business, then that's when authorities are starting to investigate and asking more and more questions. So if there is one thing that can trigger a tax audit faster than anything else, it's suspicious transfer pricing. Tax authorities love to look at companies that consistently report losses in high tax countries, like to entities that pay large royalties or management fees without showing real value behind it, like sudden declines in profit after internal reorganizations, for transactions involving tax havens, naturally, and of course missing documentation. In fact, some countries have automated risk scoring system that flag returns for audit based on transfer pricing red flags. So for any company operating internationally, transfer pricing isn't optional, it's a compliance priority. Transfer pricing has become one of the most important battlegrounds in international tax. Why? Because governments are under pressure to protect their tax base, and multinational companies are under pressure to minimize costs. So the result? There is a delicate, high-stakes dance between tax authorities and corporations. That's why why we've seen global initiatives like OECD BEPS project, for this base erosion and profit shifting, designed to close the loopholes and increase transparency. Transfer pricing is central to that effort, from mandatory documentation to reporting where profits are made, to ensuring that profits align where the value actually is. Let's look at a few real-world examples to drive the point home. Example 1. Starbucks. For years, Starbucks in UK reported very low profits or even losses, despite strong sales. Why? Because it paid royalties to a Dutch affiliate for the use of Starbucks brand, and high prices to a Swiss affiliate for coffee beans. The UK public and parliament were outraged. Technically, this might have been legal, but the optics were terrible. Eventually, Starbucks agreed to voluntarily pay more UK tax just to calm the storm. Example 2. GlaxoSmithKline in the US. In the early 2000s, GSK faced one of the largest transfer pricing disputes in US history, over $5 billion. The IRS claimed the company's US subsidiary underreported profit by paying too much to its UK parent for IP rights. After the years of litigation, they settled for $3.4 billion. So what's the moral of the story? Transfer pricing mistakes can get very, very expensive. So yeah, transfer pricing is about compliance, documentation, and managing audit exposure. But it's also about building a solid financial strategy for your group. The best companies treat it like a strategic asset, not just a tax burden. They used to it. They know that they need to align business units with clear profit expectations, reward value creation in the right parts of the business, build trust with stakeholders and tax authorities, support global decision making with clean, defendable numbers, right? Let's sum it up. Transfer pricing determines where profit is reported across countries. This affects how much tax the group pays globally. It's a key driver of a business structure and tax strategy, where you hold IP, where you book risk, and how you price your transactions, internal transactions. It all ties to transfer pricing. It's one of the most audited areas in tax. Mistakes or aggressive positions can lead to quite huge adjustments, penalties, and reputational damage. It's not just about compliance, it's about control. When done right, transfer pricing gives you clarity, consistency, and credibility across your global operations. So, we've covered the theory. We've looked at how to build a system. Now it's time for the fun part. How multinational companies actually use transfer pricing in the real world. These aren't just academic examples. They are strategies used by some of the world's largest companies to align profit with function, manage tax exposure, and comply, or sometimes push the limits of the rules. Now, to be clear, this is not legal advice. We are about to discuss for educational purposes to help you understand how transfer pricing works in practice. Let's explore some of the most common models and tactics used in global transfer pricing. So, this is a classic, the centralized IP ownership. Imagine you're a global tech company. You've developed a killer piece of software or a patented groundbreaking product. You now have this intellectual property that's incredibly valuable. Where should you hold it? Many M&As choose to centralize IP ownership in a low tax jurisdiction. Think like Ireland, Switzerland, or Singapore. Why? Because once the IP is there, other group companies, sales offices, manufacturers, distributors have to pay royalties or licensing fees to use it. That means profit is being relocated from high-tax countries like the US, Germany, or France to lower tax countries where the IP is legally owned. It's like setting up a toll booth inside your own group. Each internal entity pays to drive through the brand, so they also use the tech or processes. As long as the royalty rate is arm's length principle compliant, and the IP owner actually performs development, enhancement, maintenance, protection, and other examples, this model can be perfectly legal and effective. But if the company is just a shell with no real people or functions, tax authority will bounce hard. Let's move up a level. Many multinationals, especially in manufacturing or distribution, heavy industries, use a principal company model. Here is how it works. One entity, the principal, naturally, is designated as the central entrepreneur. It makes key decisions, owns the IP, takes the risk, controls the strategy, and the rest of the group, like regional distributors, factories, or service centers, they act as limited risk entities. For example, contract manufacturers, limited risk distributors, service providers, they all get a steady, predictable return, like 5%, 8%, 10%, based on their function and risk profile. But the principal keeps the residual profit, the upside, if things go well. So, in real-world analogy, imagine you are running a global chocolate company. Your Swiss principal sources cocoa, develops recipes, owns the brand, and sets the strategy. Your German distributors just sells the chocolate locally. They don't set the price, they don't carry major risks. They get a fixed margin, say 4%. But if a new product line takes off and global profit soars, that extra margin stays in Switzerland, where the principal is located. And of course, tax it at the favorable rate. This model can work brilliantly if it's backed by real substance and well-structured intercompany agreements. Next up, centralized services. Almost every multinational has a headquarters or a regional hub that provides services to other group companies. Think legal, finance, HR, it can be procurement, strategy, marketing. These aren't free services, right? At least not under the arm's length principle. So the headquarters charges a management fee to local entities that benefit from it. But here is where it gets a little bit tricky. Tax authorities often challenge these fees because they lack clear documentation. The local entity didn't actually benefit. the charge is seen as too high, or the service is duplicated or unnecessary. So, if you are charging management fees, you need to be sure you covered a few topics. 1. A clear intercompany agreement and a benefit test to show the real value delivered. A cost allocation model. You need to have this supporting evidence like meeting minutes, reports, presentations, deliverables. So otherwise, the head office support fee might become your next audit headache. That's a big one. Here's another example. Large groups often centralize the treasury functions, with one entity lending money to others, managing cash pools, providing guarantees. But intercompany loans need to follow transfer pricing rules too. That means the interest rate must be arm's length. The borrower's creditworthiness must be considered. The term of the loan, maturity, currency, collateral must be realistic. There must be documentation proving that loan is real. Some groups have been challenged for charging too little interest to subsidiaries in high-risk countries, effectively shifting profits. Others get caught when they overcharge interest to low-tax entities, creating deductions where they don't belong. As global rules tighten, especially under OECD guidance on financial transactions, this area is getting more and more attention than ever. Let's wrap up with something more advanced. In high R&D industries like tech, pharma, automotive, groups often use something called cost-sharing arrangements. The idea behind is like this. Multiple group entities agree to jointly develop an intangible, say a new drug for pharma industry or some software platform. Each contributes based on expected benefit, and in return, each gets used to use the IP without paying royalties later. It sounds great, right? That means calculating expected benefit correctly, monitoring the actual outcomes, making buy-in payments if one party joins late, adjusting contributions over time. CSAs can reduce long-term royalty flows and simplify pricing, but they require careful modeling, robust documentation, and full transparency. Tax authorities are usually skeptical because the stakes are pretty high. Done well, they are efficient. Done poorly, they are audit magnets. Now, what if all this goes wrong? Let's say your transfer pricing isn't documented. Your intercompany prices aren't arm's length. Or just structure is all tax, no substance. What's the worst that can happen? Unfortunately, quite a bit. Here is a list of things that you might face. First of all, tax audits. Your group could be audited in multiple countries simultaneously. Profit adjustments. Tax authorities can reallocate profits and increase your taxable income. Double taxation. Two countries taxing on the same profit without any relief. Penalties and interest. So many jurisdictions apply steep fines for missing or inadequate documentation, often 10 up to 20 or in some cases even 30% of the adjustment. It's also reputational risk. If you are recognizable brand, you might end up in the headlines or even in parliamentary hearings. And also in some countries there's personal liability. Management can be held personal responsibly for serious transfer pricing violations, especially where the fraud or negligence or deliberate non-compliance is proven. So that means potential fines, director bans, or even criminal charges in some extreme cases. So transfer pricing isn't something you can wing and hope no one will notice. So if it goes wrong, it gets really expensive fast. That's why perspective is here very important, and proactive compliance is always cheaper than a reactive fix. Whether you are a CFO, tax professional, or founder going global, transfer pricing is not just tax compliance. It's a strategic tool to control where value is created, how it's measured, and where it gets taxed. And understanding it is crucial in today's evolving global tax landscape. If this helped demystify transfer pricing for you, hit the subscribe button for more expert level breakdowns made simple. Drop a comment what transfer pricing challenge is your team facing right now. And you can check out our next or previous videos. I'm Michael from PREZO, and I hope to see you in the next one.